So this is part 2 of the financial ratios. Uh, as you may recall from part 1, this is the slide I stopped at, and this is my transitionary start slide into the next subject. And again, it is still analyzing the companies. It is still part of the ratio. In the earlier module, I gave you an overview. Why would somebody do as far as ratios? And I think that looking at it, what I like to call understanding it from a 40,000 feet, why one would use some of these concepts and methodology is super important before you get into the nuts and bolts of calculation. In my experience of being in the business for a long time, using ratios to analyze companies, using ratios to run businesses, now teaching, looking at the case studies, what is super important is to understand as a business person the methodologies at a 40,000 feet and have a feel for what this means before deep diving into the number crunching part. At the end of the day, what you are going to find that as you are business leaders and as you become moving up in an organization or your own businesses, you will always find people who can do the number crunching for you. What is important is that you understand the number crunching, because now you're delegating it to somebody else. So that part is important, and that's what I'm going to talk about in this module. But what is also important, and as a leader even more important, that not only do you understand the number crunching part, but you also understand the 40,000 feet perspective to say, why are we doing what we are doing? Okay, so here we're going to get into the number crunching part. So again, in the last one I said the ratio is about looking at a patient. The question is how bad a shape the patient is, or how bad a shape the company is. Is it just basically fine-tuning it in terms of some, few changes to make to the health of the business, looking at it to see where the opportunities are and coming up with the medicine or the strategy to do that. Okay, so ratios are like tests for a patient. Depending upon what the situation is, you would look to see in different areas. So typically when you're looking at the ratios, you're thinking in terms of, is it a company in financial trouble? Is it, in such a bad shape that company in such a bad shape that we need to worry about the liquidity ratios? Or if they want to grow and they need money, how does it look like in terms of the debt ratios? Can they afford to borrow more without taking a risk of jeopardizing the risk of the company? How does the equity ratios look like and price to earning ratios look like? Overall running the business, for example, how effectively are they managing their assets? They may have a whole bunch of fixed assets like plant, equipment. They may have short-term assets or current assets like inventory and accounts receivable. How effectively is it managed? Because assets are needed for a business, but if you tie up your assets, you're basically tying up your money or your cash. The cash could have come from either your own investment or come from debt, but that's the money where it is tied up. So you want to make sure that your investment, your money tied up in your assets, is providing you good results. The second thing is to look to profit management, to say, okay, you are selling a lot, selling 100,000, 100 million, 1 billion, whatever. The question is, how much profit is it creating for you? If you sell $1 billion and make no profit, then obviously you have got all these assets tied up, you're spending all this time and money, and you're getting no profit, so why bother? But obviously if you are making more profit for dollar of sales, that shows that your company is healthier than somebody's profit per sales margin is less. Okay, so that's really is the ratio thing. So the ratios fall into 5 categories. They fall into 5 categories, and I want to do is to again touch on each one of them, because once you understand that, and when you then see the formulas, at least you will know at what point do you use what ratios and what do you do with it. Okay, so let's think about each one of them. First category of ratio is what's called liquidity ratio. And again, this is the patient is in real trouble. You have the patient in the ER. Can the company meet its obligation for the short term? They got some bills coming up. They may have bought stuff from supplier on accounts payable, and they're supposed to pay that in 30 days. If they don't, they cannot get any more material. Or they could have some short-term debt coming up, or they could even have interest that they have to pay on a longer-term debt, which means the long-term debt is not due maybe for 10 years, but if they don't pay interest on time, obviously it's going to put the long-term debt on jeopardy. So that would be the area where you're thinking really, really short-term to say, hey, this company, if I'm going to invest in this company, or if I am trying to acquire that company, I have to see from a liquidity perspective, what can happen to this company in the short term. The second category is called the solvency ratio. This is now, we are beyond the liquidity ratio, which means, yes, short term they can make it. But the long term, how does the debt obligation look like? How much debt do they have compared to how much the equity they have? How much debt do they have to overall business sense? This is what you're looking to see on a longer term perspective, how solvent this company is. First one was short-term solvency. This is more of longer-term solvency. Okay. The next one is that, okay, company is doing okay, but how effectively are they managing their assets? Did they get carried away putting in all these assets but not getting a return on it? A return in the sense that if you look at the sales they're producing for every dollar of asset they have tied up, what does that mean? Or if you take even a finer cut and look at some of the assets like accounts receivable, as we know, is a current asset, or inventory, again, a current asset. How effective is that being managed? Next, to look at the profit ratios. So you said, okay, they are selling, they are making profit or not making profit. How effectively they are doing it based on amount of assets they have tied up or amount of sales they are doing. Third category is market value ratio. We will not get too deep into this one in this class. I do, teach this material when I'm teaching investment strategy class. But over here, I'll touch on a couple of the ratios that will be important to you, especially when you get into the capstone class. Okay. So let's start out with the liquidity ratios. Again, these are the ones that are be concerned short term, and we want to know what are we trying to accomplish here. These are liquidity ratios. Measure a company's ability to cover its short-term debt obligation in a timely manner. And there are three ratios that are typically used. First one is called current ratio, the quick ratio, and the cash ratio. And I will tell you up front, then I'm going to repeat it again before I change the slide. As you go from current ratio to quick ratio to the cash ratio, you're still looking to see, is a company able to cover its short-term debt? The difference from going from current to quick to cash is you're becoming more and more conservative as far as looking to see company's ability. Okay, so now when I go through the formula, you will see what do I mean by that, and then in the end of this slide I will say what I just said, and it will make some more sense. So the current ratio is to look at the current assets that obviously would come from the balance sheet. As you know, that's what the current assets are, and you compare that to the current liabilities to say, okay, here are the current assets. That would include you will have cash as the current assets. You have inventory, which is in the current asset. You have accounts receivable, which is also current asset. Okay, those are typically, or some short-term investment, those are typically the current assets. Current liability will include your short-term debt, stuff that is more short-term, that you may have a credit line, or money that is you have to pay in less than a year. Accounts payable, which means you have purchased stuff on account. Now you got to pay your suppliers. Obviously, typically it is terms of less than 1 year. So those were the example of current liabilities. So in current ratio, which we're really looking to see, the stuff that we have in the asset that is short term, accounts receivable, inventory, cash, so on. How does it compare with the short term debt? And you want, obviously, this number to be higher than this number. The question is, what is the right number? That depends on the industry. Typically, you definitely want to have more than one. Obviously, less than one. It may be okay as long as you have a plan to recover it. So you want to do is to have a comfortable margin, at least one or higher for that. So what is a quick ratio? A quick ratio is basically saying that, yep, I'm just going to change the color of the pen. That yes, we said that we have inventory in our accounts, in your current assets. But what if it's a type of a business with inventory they may have, it's really not worth a lot? And what would an example be? An example would be, let's say there is a clothing store, and one of the inventory they will have is all the clothing they have on the shelves or in their storage. And just like when we did the Max Inc., we had to buy lumber and we had to do, we had to buy some supplies. So that was, part of the inventory that we needed it. In the case of a retail store, it would be sweaters, shirts, pants, whatever. So the value of the inventory, as far as the dollar value is how much they have it on their books or the balance sheet, is going to be based on what they paid. So if they paid, let's say, $20 per sweater and they plan to sell it for $40, inventory value will say each sweater I have up there is $20. Now, what if they were bought 2 years ago and now the fashion has changed and those sweaters cannot be sold even for $5? Maybe the color, maybe the style, whatever it is. So just because you have inventory on your books, because that's what it was worth when you paid for it, doesn't mean it is worth that much. So sometimes what happens is business investors, when they're looking at a business, they're going to say, we will assume in that situation that all the inventory they have is really worthless, which means we will not gain anything. We'll probably have to throw it away. So in that case, what they do is to say, I am going to be a little conservative and I'm going to take the inventory out of my current assets, and then I'm going to calculate the ratio and see if I can still cover my current liability. In all three cases, all these three formulas, we're trying to figure out is, do we have enough cushion to cover the current liabilities? Now, so as you can see why when I said as I go down from current ratio to quick ratio and then from quick ratio to cash ratio, we're just getting more and more conservative. So in the case of quick ratio, we are saying inventory may not be worth it. So now we are left with, so we took the inventory out. So now we are left with accounts receivable. Now suppose there is a situation when you're looking at a business for investing, or company wants to acquire that company, or you are a bank, you want to lend them. What if you look at the accounts receivable? Accounts receivable, as we all know, is money that your customer owes you, which means the reason it is an asset is somebody owes you, and hence, that's an asset. But what if you look at those customers and realize that many of those customers they bought 6 months ago, a year ago, have no financial capability to ever pay this business back? Either they were already bankrupt or they're struggling themselves, and they will never see the money. So if you want to be even more conservative in your thinking, you're basically saying that, okay, first I conclude inventory is no good, and I'm going to conclude accounts receivable is no good. So you take that out, and only thing you got left is the cash. So if you get enough cash to cover the current liability, that obviously is in a very, very good shape. Okay, and that's the reason typically you start here, and if you're concerned about it in the business, you would go here. If you're concerned about the accounts receivable also, you'll come down over here. Okay. So I will not spend a lot of time here on these charts. What do I mean by that is I have some example charts in here and some commentary on the bottom. Again, you will have access to the charts, obviously, to the recording, and you should just read it. At least punch line over here is there are some examples of company, Cogswell and Spacely, and what the ratios are and what the commentary is. And obviously, you can just to make one comment over here, the quick ratio and even the current ratio is better for Cogswell compared to that. So everything equal, Cogswell seems to be in a better shape when you're looking at some of these ratios. Okay. So now we get into more the solvency ratio. I said, we go beyond, we look at the company and said we are not concerned about their liquidity. They're doing fine short term. They can satisfy the short term obligation. And so typically if you're looking at a case study and if you're looking at a company like Coca-Cola or McDonald's or Intel or GE, you will not be concerned with their liquidity ratio. The strong companies and so on. In that area, you're not worried about doing tests for this patient because you know they're doing well. You look to see more longer term, and that's what you would, in that case, you would not even bother looking at liquidity ratio. You can quickly check it to put your mind to ease, but overall, you're going to find that you were looking at more the ratios to see how solvent they are long term, how effectively are they managing their assets, and how effectively they're managing the profits. Okay, so, but anyway, long-term ratios will be measuring companies' ability to meet its long-term debt, and obviously failure to meet long-term debt will cause a problem. Okay. So here there are three ratios to think about. First one is looking at the total debt. Okay. If I compare if I look at the total assets they have in a business, all the assets, both current assets and long-term assets, think of current assets and long-term assets. That's total assets. Comparing total liability, current and total, how does that look like? Obviously, you want the liabilities to be less than total assets, which means you want this number to be down. Okay. Then next one is to say, okay, well, what about interest that could be due on a longer term debt? Can I afford to pay? This is what is called the times interest earned. As you may recall from your income statement, obviously we start with sales, we have cost of goods sold, etc., and then we draw a line and we say, okay, now we are at the point where we look at the earnings before interest and taxes. And we draw the line after putting in all these costs over here, and we get that number. The next item obviously is interest, because this number is before interest. This is interest. Okay. So the thing we're trying to compare to say this money that we have and what we have to pay for the interest, are we comfortably covered to be able to do that? And the reason that becomes important is, even if it is a long-term asset, long-term debt, a debt that may not be due for 10 years, but the interest is due every period, be month or annual. So you want to make sure you can comfortably cover paying the interest, because you cannot. And depending upon the terms and conditions on your loan, the bank could come after and call you to liquidate your assets so that you can pay back their loan. So that's why you're looking at the EBIT divided by the interest expense. This is another flavor of that, cash coverage ratio. In this case, we're taking the EBIT, which is obviously this line over here. We're also adding back depreciation, which obviously is someplace up here. And the reason we do that, because that's a non-cash expense. And that basically could do it. So overall, if you use this one or this one, they basically will tell you the same thing. But the whole idea for looking at either one of them is to see, do you have enough money over here to cover the very next important item, which is the interest. Yeah. Again, I'm left here some example. You can read it, look at it. Let's go to the next category of ratio. They call the asset management. And this is to see if, how, we got money tied up in our assets, how effective are we, okay? So what are some of the assets? Obviously, we know inventory is an asset. We know receivable is an asset. We can look at the total asset, all the assets, okay? First two over here, and they're basically the same, and you will see why. But they are really looking to see how effectively are we managing the inventory. As you may recall, when we did the max analysis, more inventory we need, more working capital we need, and hence more cash we need in the business to support it. And hence we want to be very judicious about managing our inventory. And typically, if it is a manufacturing firm where they do have, quite a bit of inventory, that's why you hear things like Kaizen and lean manufacturing, and they have assembly lines and so on, where the goal is to be able to move the product faster through the factory and be able to ship it to the customer as soon as possible. So that's where the inventory comes in. So what's the formula? The formula is that you're looking to see how much cost of goods sold, which is coming from the income statement, and comparing that to the inventory. So when you're looking at the inventory turnover, you're really saying is that if I look at this process, where we have lumber and raw material coming in, and then it is leaving the facility, this is the amount of time it takes for me to make the product that I am making. Okay, and hence this is the time I need to carry my inventory to do that. Okay, if I can make it faster, and let's say instead of taking this much time, if I can make it in a short time, I am turning the inventory faster to be able to get out in shorter time. So inventory turnover means how fast am I turning the inventory from bringing the raw material, producing the product, and shipping it. So you obviously want inventory to be higher. Okay, you want it to go through faster, turnover higher. Same thing sometimes is looked at it to say, okay, instead of thinking of it in turns, what if I looked at it in terms of how many days worth of inventory do I have? How many days worth of inventory do I have? That means if there are 365 days in a year, how many, if I look at my inventory, how many days will it cover? And so the way you do that is you're taking 365 and you're dividing it by turnover. So you do this in 2 steps. Obviously, in this case, you want number to be small. What do I mean by that? You want less days inventory tied up versus long days. You want inventory days to be short. But if you're thinking in terms of inventory turnover, you want to turn faster. So obviously you turn faster, obviously you're going to carry less inventory in number of days, so on. Okay. Accounts receivable is obviously another asset. And in that case, we're looking to see our sales versus accounts receivable. Okay. Now typically the sales you would put it in would be the credit sales, which means if you know how much of the sales is credit, because some could be on cash, you want to do is to put the credit sales, because obviously the accounts receivable is tied to stuff that you are selling on credit. I'm not talking credit card. I'm talking about you gave it to the customer and they're going to pay you in 30 days. That's the terms. If you don't have information in a case or whatever, you can just assume everything is on credit. But if you do, you want to break it out and look at the credit sales. This is really credit sales. Similar to the cost of goods sold, in this case, you're taking the credit sales, and if no credit sales breakdown available, look at the total sales, divide by the accounts receivable balance from the balance sheet, and you will get that number. And you want to turn faster, which means you want to be able to collect money faster from your customers so you can take your product and eventually end up with the cash as soon as possible. If you want to calculate it in a number of days, obviously you do the same thing like we did above. You're going to take it and say, okay, how many days worth of accounts receivable am I carrying? So you're taking 365 and you are dividing it by receivable turn. This one is to say, okay, if I look at all the assets, total assets, including my fixed assets, money they may have put in the facility, the equipment, the plant, and so on, and the current assets, and compare that to the sales, how does it look like? Obviously, we want to be able to create more sales per asset tied up, but that's what it is. Okay. Profitability ratio. Again, now you're looking to see how effective they are in managing their profits. Here, 3 ratios. All 3 ratios. Obviously, we're comparing it to the profit, which we all know is net income. Okay. First one is to say, it's called profit margin, also called in some books or some companies return on sales. And the reason they use this lingo is if you look at the other ones, this one is return on assets. This one is return on equity. Okay, and that's why sometimes companies, instead of calling it profit margin, they will call it return on sales. Because in reality, profit and net income, the word profit and net income are synonymous. Okay. A profit margin or return on sale basically to see how much profit, net income I'm producing for every dollar I'm selling. Obviously, you want this number to be higher. You're selling stuff, but you want to obviously be able to make more profit. As an exercise I will give you, so you really start to get a feel for it. Go look at, go to Yahoo Finance and go look at the Apple as a company. Okay, and maybe look at Walmart. These are 2 very, very large, very, very successful companies. Okay, different industries, different business model. Look at these ratios for them. When I say look, you'll have to calculate it. You'll have to take the net income divided by sales, net income divided by total asset, and you will see some differences. and it'd be worth for you to kind of ponder over it. And that's one way to learn things is not to just memorize the formulas, but to be able to apply. So go look at those two companies and see what you think. Okay. Market ratios, again, I will not get into it too much and in here for this class, but I want to touch on it because it's something that a couple of ratios that are important. But overall market ratio basically means is, from a potential investor perspective, or the analysts that monitor the stocks and recommend is a buy, sell, or hold, or whatever, what do they look for? Okay. There are 4 ratios they look for. I'll touch on all 4 of them. But at least the top 2, you want to at least have a good feel for it. Okay. First one is that they're looking to see now from a shareholder perspective. That's why they call market. When they say market, they're really talking about stock market. Okay, that's what they mean by market, is stock market. Okay, so that means the investors, the stockholders, what are they looking at it from their perspective? So in that case, what they do is, in order to compare and see how things are going, especially the trend year over year, they are normalizing it based on number of outstanding shares in a company. And again, if you ever want to see what that is, you go to Yahoo Finance, look at a company, it'll tell you how many outstanding shares they have. They will even tell you what this number is. They already calculated it for you. What that is to see the net income divided by outstanding share. What you want in a successful company, you will typically find that if I look at the earnings per share over time, okay, and if it is growing, it is not the absolute number that is important, it's a growth number. I mean, if it is growing, you're going to find typically that if I look at that company's stock price, it is also going to be growing. If I see a company where the earnings per share are not growing or they're starting to drop, you're going to find the stock price also starts to drop. Because the reason is, this company over here, which is doing well, and the stock price is, the reason it's doing well is because the investors know that they can create more profitability, and hence the company is going to be worth more. Okay. The other ratio that the investors look, and you may hear about it a lot, especially if you are watching some shows or reading a newspaper about stock market, is what's called price to earnings ratio, where they're really seeing to say, what is the stock worth today for that company, stock price. So this is stock price, and obviously that number will change literally every hour, every day. And you're comparing it to how much earnings they're creating per share. So basically what they're doing is looking at the price of the company, overall value of the company, and comparing it to the earnings per share. So you want to do is to get comfortable with these two a little bit more. These other two, I'll touch on it in case if you ever come across it. This is called a PEG ratio. This is looking at the growth ratio, and that's how you would calculate it. And again, for you at this point, not that important for this class. Market value book is to looking at the market per book value. So at this point, you want to start to get comfortable with these two items, okay? So just some commentary on how would what does that mean, trying to kind of tie it all together, is that if you got two companies, obviously Pepsi and Coke, why would they be compared? Because they are in the same industry. You can start to make some comparison. Obviously Pepsi is doing a much better job return on equity, return on assets, they're doing a much better job. The current ratio is better. The PEG ratio, which we didn't really touch on it, because it's part of our stock market, but it is low. These two things we really didn't talk about, so I'm not going to spend too much time here. Inventory turnover, again, like I said, higher the better, so this is better. Debt to equity ratio, lower the better, which means so this company is better. Net income overall, dollar value doesn't mean much, but what matters is if you look at the gross margin, basically mean how many dollars they got left over from after they subtracted the cost of goods sold, slightly lower than this one. Earnings before taxes, which is your EBIT, slightly better. And then earnings per share, also slightly better, and so on. So this is how you typically would, when you're comparing your company with your competitor, you start to identify. You can see over here, there is no mention of any liquidity ratios. Why? Because these are obviously solid companies, and hence you would not even bother looking at the liquidity ratios. Okay, you look to see more the financial performance ratio. Now, if you're comparing it to a new startup company or company that is struggling, for example, let's say you're comparing a company like BlackBerry, the company that makes devices for the phone, BlackBerry phone. Now, this company did really, really well for a long time, but they're now really, really struggling. So if you want to compare BlackBerry, yes, you would look at the liquidity ratios. Why? Because they're really struggling now. Okay, so that's where you have to decide as a business person which ratios you would use. Now, if it's a case study, you don't know exactly what it is, then obviously you want to touch to see you have looked at all the ratios. So, if you have a case study, you want to make sure you looked at all the ratios and then make a commentary on they're looking at liquidity ratios, they look fine, and here is why. If I look at the trend of liquidity ratios, they look fine, and here is why. And then you can say that what I really want to focus on is the profit ratio or the asset management ratio, and here is why, and then your conclusion of what it means, and then what recommendation would you have if they want to get better. Okay. From a trend perspective, as I mentioned to you, a few times before, that when you're looking at the ratios, you're looking at it all. One is comparing it with your competitor or a peer or an average, but also from a trend perspective. Okay, so in this chart, for example, if you're looking at now here you're comparing, doing both. You're comparing the trend over time. You're comparing trend over time, but you're also comparing the years. So you got Pepsi and you got Coke. You can see, what are they doing year over year? This is kind of basically staying flat. This goes up a little bit, then goes down. You can see this thing. So you can see from here, you can draw both conclusions. If I look at, let's say this was the latest data. Let's say this was happening in 2006. If you're doing this thing, you probably look at 2013 data. Because we are in 2014, there is not much 2014 data available. So you'll be looking in 2013 and you can kind of see what's going on. Then you can go back in time for a few years and say, hey, how does it go on better? So now what you have done over here, you compare two companies, both today, but overall at time, is one getting better at a faster pace or one getting worse than the other and so on. Okay. So this is the end of my discussion for the formulas and the ratios and how would one apply it. Okay, and so there's an example in here that I was just going to touch on, but want you to look at it. Basically, here it's saying a company industry averages for that industry looks like this. Then you want to compare the industry average to say that company, how does that look? And from there you can make some comparison. For example, their cash coverage is much better than industry. The days receivable is much better. Why? Because you want less days, so that's much better than industry. Inventory turnover is about the same, slightly worse, which would mean the days receivable are going to be a little bit higher. So they're slightly worse, not a lot, it's been a little bit. And profit margin is slightly better, 5.3% versus 4.5%. Return on assets about the same. Return on equity slightly. So you could this is how you would make a comparison, industry average, or you compare it with another company. Okay. So here I want to stop. Again, this is the end of my second module or part 2. I will start again at this slide. So hopefully you have listened to both part 1 and part 2 by now.